Hi, I'm Mal from the Money Study, bringing you another episode of our Take 10 Challenge. And we're up to number 29, talking about salary sacrifice. Before we kick off, there's the disclaimer, facts and figures, information only. This is not advice. Now, in the previous sessions, we've been talking about making some concessional contributions where we get a tax deduction. And yes, we can do that without having an employer. We can literally just put some money into a super fund, fill out a form, claim a tax deduction, and get that money back at tax time. A bit of extra effort involved in that, of course. Got to fill out a form, but we can indeed do it through your employer. So if you're actually working for somebody, you can indeed get the same result by getting tax deductions by asking your employer to make these concessional contributions on your behalf. So therefore, there's no form to fill out. So literally, your employer is telling the super fund that these are pre-tax concessional type of contributions. So it's all done automatically. You can start this salary sacrifice with the employer. You could stop it at any time. You could increase the amount. You can decrease the amount within all the caps and so forth. So it's pretty flexible, but remember that your employer does not have to let you do salary sacrifice. Generally speaking, these days it's pretty common. I mean, there's very few employers that would turn you down. But having said that, there are some employers who just don't understand it. I had an employer who said, I'm not going to let them do salary sacrifice. Why would I give up all that tax? I'm going, it's not your tax, it's theirs. He just didn't understand how it all worked. So look, what it comes down to, your employer's not impacted at all. It's really just who's missing out? The tax department. And why do they let you do this? Because they're trying to encourage you to get more money into super so you can be a self-funded retiree. That's the whole point. So let's have a look at how the salary sacrifice thing works. What it boils down to is, let's have a look at the column there where it says does nothing. This is somebody who's got a gross pay. Their gross pay before tax is $90,000. They pay that tax there of $21,517. Therefore, their take-home pay is the $68,483. So pretty straightforward. They've got a gross income. They get hit with normal tax by working, and therefore their net is $68,483. So their total benefit by doing nothing, but well, they've got to go to work, is the $68,483, which is their net income. If we can then compare to the next column across where the person decides, yep, I'm going to salary sacrifice $10,000 in a year. And so what happens here is that they're gone to their employer, said to the employer, drop my salary from $90,000 down to $80,000, and I want you to put that $10,000 into my super account as a salary sacrifice or a concessional type of contribution. And so therefore, your gross income for this person has dropped by $10,000. Their gross income is $80,000. And because their gross income has dropped, then so will the tax, because they're only paying tax on the $80,000. Therefore, their tax bill, instead of being $21,517, is now $18,067. So you can see the tax savings there is $3,450. Now, of course, if there is a savings in tax, it means you're getting this tax benefit every fortnight. Unlike the person who just fills out the form and claims at the end of the year where you get the money back at tax time, you're not going to get this money back at tax time because literally you are paying less tax every fortnight. You're getting the benefit along the way. But you can see there, this person has given up $10,000 worth of gross income, but their net take home is a difference of only $6,500, $6,550. So it's not like they're actually giving up $10,000. They're really only giving up $6,550 in that regard, as far as take-home income is concerned. So now, of course, this person has put the employer has put $10,000 into their super fund for them. Because it's a concessional contribution coming from an employer, it gets hit with a 15% tax, so only $8,500 is what actually lands into the account. Therefore, this person's total benefit is their take-home pay of their $61,933 the $8,500 that has actually landed into their super fund, a total therefore of $70,433. So this person is in theory $1,950 better off by doing the salary sacrifice every year. And I say you can do that next year and the year after and the year after. And because of the cap, if they could afford to do more, it wouldn't really be a problem. They could indeed do more. It just comes down to, what is the employer putting in? What is the current cap? How much can you afford to do? And so forth. So you can see there that, just as I say, what we're doing here is we're making money literally just by giving up some money to put it into our super fund. Now, of course, we've got to have that money to afford to do so, and that's not always easy. But we will be talking about some other strategies a bit later on in some of the other sessions. But of course, the benefit is we are increasing our money going into our super. It's making our super fund grow better. It's compounding. A little bit of an example there on the left-hand side. You can see, consider a member starting at 50. They decided to start doing some salary sacrifice at 50. They had a $20,000 balance at 50. And the person compared to doing nothing compared to the person who does a salary sacrifice ends up with 1.2 million compared to the person who doesn't at 935. So, pretty reasonable difference there. Now, that's at age 65. So 15 years later, made an assumption there of investment returns of 7%, which has been pretty typical of balanced funds over the last decade or so. Not too sure that's what we're going to get going forward, but just for this example, you can see that yes, making salary sacrifice contributions, even though this person is 50, still got time in their side to make a significant difference there. So not only are they getting the tax deduction every year, they are indeed getting more and more money into their super fund and providing them obviously with a better chance of a more comfortable retirement. So it all comes down to this whole business of what your taxable rates are. And I've just highlighted those tax rates again that we talked about in an earlier session. Obviously, if you are in and earning more than 120,000, you're into this 37 cents in the dollar. Now with the stage 3 tax cuts, that's looks like it's going to 135,000. So if you're earning more than 135, you'll be into that next tax bracket, in which case your tax deduction, effectively, how much you're going to be saving more tax because you're paying a higher rate of tax. Hence, if it's pre-tax, you don't pay your 37, you'll only be paying the 15% contributions tax. Always just a case of looking at your scenario, what you can afford, and understanding the benefits, talking to your employer and setting this thing up, but remembering that you can cancel it at any time. Look forward to you joining me on another session.